What if I told you the biggest threat to the American dream of homeownership isn't high mortgage rates, rising prices, or even your neighbor outbidding you? It's Wall Street itself? And leading the charge is a company so powerful, so wealthy, and so far-reaching that some say it practically owns entire neighborhoods. That company is Blackstone. This isn't just a story about real estate. It's a story about how one private equity giant quietly turned a national housing crisis into one of the most profitable business empires in America. And in the process, they've reshaped what it means to rent, own, and even dream of having a home in this country. Back in 2008, millions of families lost their homes during the housing market crash. To most people, it was a tragedy. To Blackstone, it was an opportunity. While ordinary Americans were fighting to keep a roof over their heads, Blackstone was quietly buying up tens of thousands of foreclosed properties at bargain prices. By 2012, they launched Invitation Homes, which would grow into the largest single-family rental company in the United States. At their peak, they controlled more than 80,000 homes across dozens of cities, transforming suburban neighborhoods into corporate portfolios. What was once the heart of the American middle class, the single-family home, was now just another asset on Wall Street's balance sheet. In this video, we're going to unpack how Blackstone pulled it off. From the ashes of the 2008 crash, to their domination of the rental market, to the long-lasting effects this has had on families and communities. Because this isn't just a financial story, it's a story about power, inequality, and the future of housing in America. So let's dive in. The story of Blackstone's housing empire begins with the collapse of the American housing market in 2008. It was the worst financial disaster since the Great Depression. Overnight, millions of families who thought they were living the American dream, owning their own home, were thrown into chaos. Foreclosures swept across the country like wildfire. By 2010, more than 3 million households had lost their homes, and in some states, entire neighborhoods sat vacant. For ordinary people, this was devastation. Families who had spent years saving for a down payment suddenly found themselves evicted, their credit ruined, their lives turned upside down. But for investors like Blackstone, the crisis looked less like a tragedy and more like an opportunity. Here's why. Home prices had fallen to historic lows. In some cities, houses that once sold for $250,000 could be bought for half that, or less, at foreclosure auctions. Wall Street firms, sitting on mountains of cash, realized they could scoop up thousands of these distressed homes in bulk. But while most investors were hesitant, worrying about the risks of managing so many scattered properties, Blackstone saw a chance to do something no one had done before: industrialize the single-family rental market. With billions of dollars ready to deploy, they began buying aggressively in some of the hardest-hit markets: Las Vegas, Phoenix, Atlanta, Tampa, places where foreclosures were everywhere and competition was scarce. Entire suburban streets went from family-owned homes to Wall Street-owned rental properties in a matter of months. This was the critical turning point. What had been a disaster for millions of families became the foundation of a new kind of empire for Blackstone. They weren't just buying homes, they were buying control of the future of housing. By 2012, Blackstone's experiment had evolved into something much bigger than just buying foreclosed houses. They needed an organized platform to manage the thousands of homes they were scooping up across the country. That's when they launched Invitation Homes, a company that would become the face of Wall Street's new grip on the American housing market. Invitation Homes wasn't a small side project. It was a full-scale corporate machine, built with one purpose: to turn scattered single-family houses into a streamlined, profitable rental empire. With over $10 billion invested, Blackstone quickly transformed Invitation Homes into the largest landlord of single-family rentals in the entire United States. At its peak, Invitation Homes controlled more than 80,000 properties spread across over a dozen metropolitan areas. Cities like Phoenix, Atlanta, Las Vegas, and Tampa weren't just recovering from the crash. They were being reshaped by Blackstone's buying spree. In some neighborhoods, nearly every for-sale sign was snapped up by Invitation Homes before families even had a chance to bid. And it wasn't just the scale that made them different. Unlike traditional mom-and-pop landlords, who might own one or two rental properties, Invitation Homes used its size to operate like a factory. Renovations were standardized, repairs outsourced in bulk, and management centralized with cutting-edge software and call centers. What had once been a messy, small-scale business was suddenly industrialized. When Invitation Homes went public in 2017, it was valued at nearly $11 billion, instantly cementing Blackstone's dominance in the housing market. For investors, this was a triumph. But for everyday Americans, it marked a new reality. Competing for a home now meant going head-to-head with one of the richest companies in the world. How they did it: speed, scale, and data. Blackstone's rise in the housing market wasn't just about having money. It was about how they used it. While smaller investors and local families struggled to scrape together financing, Blackstone had a strategy built on three pillars: speed, scale, and data. First, speed. Blackstone could move faster than anyone else. In foreclosure auctions, timing was everything. Families often needed weeks to line up a mortgage, but Blackstone had billions in cash on hand. That meant they could make instant, all-cash offers, sweeping up properties before individuals even had a chance to compete. In many cases, they weren't just buying one house at a time. They were buying dozens, sometimes entire blocks, with a single transaction. Second, scale. Owning one rental property is hard work. Owning thousands sounds impossible. But Blackstone solved this by treating homes like assets in a portfolio. They standardized everything: painting walls the same colors, installing the same appliances, hiring regional contractors to do repairs in bulk. With this industrial approach, managing 80,000 homes became less about neighborhoods and families, and more about spreadsheets and efficiency. Third, data. Blackstone didn't buy houses blindly. They used advanced analytics to identify which markets had the highest potential. They targeted cities with high foreclosure rates, growing populations, and strong rental demand, places like Phoenix, Atlanta, Dallas, and Orlando. Their algorithms could predict not just where homes were cheap, but where rents would rise fastest. By the time local buyers realized what was happening, Blackstone had already cornered the market. This combination gave them an unbeatable edge. While families saw homes as places to live, Blackstone saw them as investments to scale, optimize, and extract value from. It was housing stripped down to numbers, and those numbers overwhelmingly worked in Blackstone's favor. But the consequences of this approach were far-reaching. As Wall Street raced to buy homes in bulk, ordinary Americans were increasingly shut out of the market. What used to be a competition between neighbors had turned into a battle against billion-dollar corporations. The impact on families and renters. For ordinary Americans, Blackstone's rise in the housing market didn't just change who owned the houses. It changed the rules of the game. Suddenly, families looking for their first home weren't just competing with other buyers on their street. They were competing with Wall Street itself, a giant armed with billions in cash and algorithms designed to outbid them at every turn. This had two immediate consequences: higher prices and fewer opportunities. In markets where Blackstone bought aggressively, like Phoenix, Las Vegas, and Atlanta, home prices began climbing rapidly. Families who thought they'd finally saved enough for a down payment found themselves priced out again and again. For many, the dream of owning a home was no longer realistic. And for those who couldn't buy, there was only one option: rent. But here too, Blackstone's dominance reshaped the landscape. Through Invitation Homes, rents didn't just rise. They often came with fees, penalties, and strict lease terms that mom-and-pop landlords rarely imposed. Tenants reported everything from higher security deposits to costly late fees, even for small delays. In some cases, renters said they felt like they were dealing with a faceless corporation rather than a landlord. Maintenance requests went through call centers. Repairs were sometimes delayed or handled poorly. Families who had once imagined stability in a home now described the experience as feeling trapped in a system where profit mattered more than people. But perhaps the biggest impact was psychological. Homeownership has long been considered the cornerstone of the American dream, a symbol of independence and stability. By transforming homes into investment vehicles, Blackstone shifted the balance. More and more Americans found themselves stuck renting from a corporate giant instead of building equity in their own property. For Blackstone, this was success. For millions of renters and would-be homeowners, it was a painful reminder that the housing market no longer played by the old rules. The house down the street wasn't just a home anymore. It was someone else's financial product. Wall Street's new housing empire. By the mid-2000s, it was clear that Blackstone had done more than just survive the 2008 housing crash. It had rewritten the rules of the housing market. What began as a bold gamble on foreclosed homes evolved into something far larger, a blueprint for how Wall Street could control the most basic human need: shelter. The launch of invitation homes was the turning point. Suddenly, the scattered single-family homes that Blackstone scooped up were no longer just random investments. They were transformed into a unified rental empire, complete with corporate branding, streamlined technology, and billions in backing. When Invitation Homes went public in 2017, raising nearly $1.5 billion in its IPO, it became the largest single-family rental company in America. That IPO wasn't just about raising money. It was proof that housing could be turned into a full-blown asset class like stocks or bonds. Blackstone's success triggered a wave of copycats. Other private equity firms, hedge funds, and institutional investors rushed into the housing market. Companies like American Homes 4, Rent in Progress. Residential followed the same playbook, competing to buy up as much property as possible. What once was a market dominated by individual homeowners and small landlords was now being carved up by Wall Street. The scale was staggering. By the late 2010s, institutional investors owned hundreds of thousands of homes across the country. In some neighborhoods of Atlanta, Phoenix, and Charlotte, corporate landlords controlled entire subdivisions. Housing, once local and personal, was being centralized into the hands of financial giants who managed properties with spreadsheets and algorithms. For Blackstone, this expansion was a masterstroke. The company wasn't just earning rental income, it was reshaping the entire market dynamic. With so many homes under its control, it could influence prices, rental standards, and even the political conversation about housing policy. Wall Street had found a new empire, and at its core were the very homes where ordinary Americans lived, raised families, and built their futures. The consequences of this shift were profound. Housing wasn't simply about supply and demand anymore. It was about power. And for the first time in U.S. history, that power was concentrated not in local communities, but in the boardrooms of global financial firms. Backlash, criticism, and the human cost. As Blackstone's empire grew, so did the anger of ordinary people who felt squeezed by the very system that was supposed to give them stability. By the late 2000s, renters, activists, and even lawmakers began raising alarms. What happens when Wall Street owns your neighborhood? Tenants were often the first to speak out. In cities like Atlanta, Miami, and Los Angeles, reports emerged of families facing steep rent hikes, unexpected fees, and slow or inadequate repairs. Some renters accused Invitation Homes of treating them like revenue streams rather than human beings. Lawsuits began to pile up, alleging everything from negligence in maintaining safe living conditions to predatory lease terms that left tenants trapped. The media caught on. Investigations revealed stories of single mothers fighting mold in their units, retirees struggling with skyrocketing rents, and families evicted over minor disputes. These weren't isolated cases. They pointed to a pattern. In 2018, a report by the private equity stakeholder project claimed that corporate landlords, including Blackstone, were systematically driving up housing costs and destabilizing communities. Lawmakers soon joined the chorus of criticism. Progressive politicians accused Blackstone and other institutional investors of financializing housing, turning homes into commodities at the expense of working families. In fact, during the 2020 election cycle, the company became a political talking point, with senators and representatives demanding investigations into whether Wall Street's buying spree was worsening America's housing crisis. Blackstone pushed back hard, arguing that it provided professionally managed homes, that its rental stock was only a fraction of the total housing supply, and that rising costs were more about underbuilding than investor activity. But the numbers told a different story. In markets where Blackstone and its peers bought aggressively, rents rose faster and homeownership rates fell lower than the national average. Beyond the dollars, the human cost was undeniable. Families who had once dreamed of owning their first home now found themselves permanently stuck renting from mega landlords. Entire neighborhoods felt less like communities and more like profit machines for investors. Local residents complained that Wall Street landlords didn't care about schools, parks, or community ties. They cared about quarterly earnings. This backlash marked a turning point in the narrative. What began as a story of bold financial innovation was now being recast as a cautionary tale about unchecked corporate power. Blackstone wasn't just a landlord anymore. It was a symbol of how far the housing market had drifted from serving people to serving profit. What the future holds. The story of Blackstone's housing empire isn't just about the past, it's about where America is heading. Because the truth is, what began as a crisis play in 2008 has now become a permanent feature of the housing market. And the question everyone is asking is simple. What happens if Wall Street keeps expanding its grip on the homes we live in? Some analysts warn that we may already be living in the early stages of a new kind of housing economy, one where homeownership is no longer the default path for the middle class. Instead, corporate rental empires dominate, and families spend decades renting from faceless landlords rather than building equity. This isn't just about personal finances. It reshapes the entire social contract. Without homeownership, wealth gaps widen, generational mobility shrinks, and the American dream slips further out of reach. If current trends continue, it's not far-fetched to imagine entire suburbs owned by Wall Street firms. Already, there are neighborhoods in Phoenix and Atlanta where nearly every house on the block belongs to an institutional investor. In the future, this could expand nationwide, with ordinary buyers squeezed out before they even have a chance to bid. Technology will accelerate this shift. With sophisticated data tools, hedge funds can track market patterns in real time, swooping in to purchase homes the second they're listed. Competing with that as an individual buyer becomes nearly impossible. What feels like a local real estate transaction is, in reality, part of a global financial game. But the future isn't written in stone. Some experts believe a backlash is inevitable. Rising political pressure may force stricter regulations on corporate landlords, such as caps on how many homes they can own in a given market or stronger renter protections. Grassroots movements demanding affordable housing could spark policy changes at the city, state, or even federal level. And if interest rates or market conditions shift dramatically, even Blackstone's empire could face cracks. There's also the risk of another crash. If too much capital flows into housing as an investment rather than a necessity, the market could become dangerously inflated, echoing the same patterns that triggered 2008. In that scenario, Wall Street's heavy presence could turn a housing correction into something much more destructive. Still, Blackstone shows no signs of slowing down. The firm continues to expand globally, buying up housing, logistics hubs, student dorms, even retirement communities. To critics, this is a dystopian vision, a world where life's essentials are bundled into corporate portfolios. To Blackstone and its investors, it's simply the future of profit. The truth is, the housing market now sits at a crossroads. Will it remain a place where families build lives, roots, and stability? Or will it continue transforming into a financial machine, controlled by the few at the expense of the many? The next decade will answer that question, and the stakes couldn't be higher. The price of the American dream. When we step back and look at the big picture, the story of Blackstone's housing empire isn't just about real estate. It's about who controls the future of American life. What started as a bold play during the ashes of the 2008 crisis has grown into a sweeping force that touches millions of families. For some, it means stable rentals and modernized homes. For others, it means being locked out of ownership, trapped in a cycle of rising rents, and watching the dream of owning a home slip away. This is the paradox at the heart of Blackstone's rise. The very crisis that devastated communities created the perfect opening for Wall Street to swoop in and reshape housing forever. Today, every bid on a house isn't just a competition with your neighbor. It's a competition with billion-dollar firms armed with algorithms, cash, and global backing. And the consequences ripple far beyond property lines. If corporations own the homes, who owns the future? If families can't build equity, how do they pass down wealth? If rents keep climbing, who gets left behind? These aren't abstract questions. They're the reality shaping America right now. The next decade will determine whether housing remains a pathway to opportunity or becomes just another financial asset monopolized by a few. Politicians, regulators, communities, and everyday people will all have to decide. Do we accept Wall Street's dominance as inevitable, or do we push back and reclaim housing as a human right, not just a profit center? Blackstone may not literally own half the homes in America, but its influence is vast enough to change how millions of people live. And whether you see that as innovation or exploitation, one thing is certain: the American dream of homeownership is at a crossroads. The question is, which way will we go?